I'm Kyle with Fundamentals of Finance, and today I'm going to dive into the investment implications of the energy crisis in Europe, which is the worst one they've had since the 1970s and way worse than what you're experiencing in the United States right now. To put it into perspective, natural gas prices in Europe spiked to over 20 times their long-run average, which is like if the price of oil spiked to over $1,000 a barrel in the US. Now, I'm certainly not saying the situation is a good one, but you'll see a lot of alarmist headlines out there about things like mass bankruptcies and anarchy coming to Europe, and I think a lot of them have gone way too far. So as always, I'm going to bring you thoughtful, objective analysis to help you cut through the crap and focus on what this really means for your investments. So let's start with an overview of what's been happening and why, and then we'll dive into some of the potential investment implications going forward. The main cause of the European energy crisis has been their dependence on Russia for oil and gas, and Russia's decision to largely cut off the gas supply recently. By the way, just to level set, when I say gas in this video, I mean natural gas, like the stuff your oven and water heater probably run on. Not the gas you put in your car, or the gas fees from the Ethereum blockchain, or the gas you get when you eat too many burritos. English is a complicated language. Okay, so the simplest sequence of events has been Russia invades Ukraine. As a punishment, Europe put sanctions on Russia to hurt their economy. Russia doesn't like that, so they retaliate against Europe by reducing their gas supply further and further to the point where now it's almost been completely cut off. That's been the main cause of the European energy crisis, but it hasn't been the only cause. Gas isn't just used directly by households and businesses in Europe to heat their homes, it's also used by utilities, aka power companies, to generate electricity, and the price of that has spiked too. So consumers are facing higher heating and electric bills. So electricity has been the other major pain point in the European energy crisis, and it's been partly driven by the spike in natural gas prices. But there's also been a perfect storm of other factors that led to more electricity demand than normal and less electricity supply than normal, further driving the price up. French nuclear electricity production has been limited since they neglected their maintenance for years. They're usually an electricity exporter to the rest of Europe, but this year they've been adding to the rest of Europe's import needs. Part of the problem rather than the solution. You've also had a drought, which has reduced the amount of electricity supply from hydropower, and there was a heat wave, which led to higher than normal electricity demand due to increased air conditioning usage this summer. Essentially, everything that could go wrong has gone wrong. Now, European governments find themselves in a variety of predicaments with conflicting priorities, each of which could have huge investment implications. Here I'll cover three that I'll be watching. Support for Ukraine versus the desire for lower energy prices. Windfall taxes on the companies making too much money from the crisis versus support for the companies suffering huge losses from the crisis, and government's desires to help people with energy prices versus central banks' desires to fight inflation. So let's start with the dilemma between supporting Ukraine and lowering energy prices. As I mentioned earlier, the main cause of higher energy prices is the reduced supply from Russia, and that's in retaliation for Europe's sanctions on them. Most Europeans strongly support Ukraine in their fight with Russia to regain their territory, but most Europeans also don't like getting $500 a month electricity bills. So far, they've been willing to take the pain, and governments have stepped in to help reduce it, but the longer this goes on, the more expensive it's going to be for both consumers and governments. The risk is that at some point, their solidarity over Ukraine could start to crack as people get tired of the higher energy prices and push for reduced support for Ukraine, meaning reduced sanctions, more gas imports, and lower gas and electricity prices. If you Google it, you can find evidence of protests that have already happened. And I'm not saying there can't be more of those, but recently a lot of European governments have been stepping in to help people and businesses cope with higher energy prices in one way or another. So as long as they keep doing that, the worst fears are likely overblown. There's also the fact that it would be impossible for Russia to fully turn the taps back on even if they wanted to, since there were just explosions at both of the Nord Stream pipelines, the main way Russia could get a large amount of gas into Europe. Who blew them up is a matter of speculation at this point, but regardless of whose fault it is, it's now even less likely that we'll see reduced sanctions in exchange for more Russian gas. Our second dilemma has to do with the proposals for windfall taxes on energy companies, meaning utilities, energy traders, and oil and gas companies that have made too much money from this crisis, and support for other companies that have been destroyed by it. Often the companies being helped and the companies being hurt by the crisis are in the same industry. How is that even possible? Well, as I mentioned earlier, a key use for natural gas is to generate electricity, which is why we've seen spiking gas and electricity prices in Europe this year. The price that electricity can be bought and sold for is the same, regardless of how it's generated. So companies who don't use natural gas to generate their electricity, like wind power, nuclear power, or hydropower companies, haven't really seen their costs go up that much, but have been able to sell their electricity for massively elevated prices. At least it might seem that way, but it's not always the case. A lot of companies sell their electricity at prices that are contracted out years in advance. So the prices that customers are actually paying utilities are often based on energy prices from a few years ago when the contracts were drawn up. That means that they're selling electricity at way lower prices than the current market price, and not necessarily benefiting the way it might seem. So one group of companies might have lots of excess profits, hence the proposal for windfall taxes on the extra money they made. But there's also a second group of companies that have similar revenues to normal due to fixed contracts set years ago, and similar costs to normal due to their energy sources not being dependent on Russian gas. So no major effect. These companies don't deserve windfall taxes or government help. Then there's a third category of companies which has to sell their energy for normal times prices, but isn't getting that cheap Russian gas anymore that they were depending on. In order for a utility to keep providing power to homes and businesses, they need enough natural gas to generate the power people want to use. Whatever they can't get from Russia, they have to buy on the spot market, which basically means they have to pay today's exorbitant prices of 10 to 20 times what they expected to make up for the shortfall. At one point, Germany's utility Uniper was losing over $100 million per day, and eventually they had to be bailed out by the German government. There are a couple stories like this one, but that doesn't mean we'll have mass bankruptcies across Europe like some news outlets would lead you to believe. The problem is specific to companies that generate electricity and rely on Russian gas to do so. That is maybe 1% of the companies in Europe, probably less. Outside of that, companies mostly use gas for electricity or heating, if at all. And as you can imagine, the utility bills aren't exactly the biggest expense on most companies' income statements. Even a pretty big increase in energy costs would have a minimal direct impact on most companies. It might eat into their profits a bit, but it's not going to put them out of business. Our third dilemma has to do with government's desires to help people deal with high energy prices versus central banks' desires to fight inflation. I have a feeling this might be a topic for its own video at some point in the near future, but I'll at least introduce it here. Central banks, like the European equivalents of the Federal Reserve in the US, are desperately trying to fight inflation right now by raising interest rates. However, European governments are significantly increasing spending to help people who are dealing with high energy prices. All that extra money in people's pockets leads to more spending and more inflation. So the governments and central banks are basically fighting each other. That almost broke the UK bond market last week and forced England's central bank, the Bank of England, to start buying long-term government bonds to restore order to the market, which has the polar opposite effect of what they've been doing, raising rates, and what they're trying to do, which is to lower inflation. This is leading to a lot of big questions that are not unique to the UK or even Europe. Like, will bond markets break down? Will central banks have to change course and let us live with higher inflation? I'll be sure to cover these topics as their trajectory gets clearer. But for now, what you need to know is that governments and central banks are contradicting each other. And that's creating distortions in the financial markets that are not sustainable and will need to be worked out one way or another. So where do we go from here? Well, it obviously depends on the outcome of the war, which by all accounts, Ukraine is winning right now. But since I can't predict how long it will last, I'll operate here on the assumption that it lasts for the foreseeable future. And should it end, I'll be sure to put out a video with my updated thoughts as soon as possible. Be sure to hit that subscribe button so you won't miss it. When it comes to what will happen next, there are obviously a lot of moving parts. So let me break it down into two sections: risk and opportunities. Risks are what the media usually wants to focus on, partly because they're obvious, partly because they make it easy to create alarmist headlines, and partly because, quite frankly, I don't think they're smart enough to point out the opportunities on the other side. On the key risk, I'll say this: I think Europe is almost certainly already in a recession. Could it get worse? Sure, but the markets have already sold off a lot, and Russia has already cut gas off to near zero, so they can't really lower their gas exports to Europe much more than they already have. There are also some positives that I think the market is ignoring, like the fact that gas prices have already come down by about 50% in the past couple weeks, and Europe's gas storage levels are over 90%, which is way higher than previous years at this time and way higher than anyone expected. To put it in plain English, we're not out of the woods yet, but the outlook is actually much better than it was a couple months ago. It's now much less likely that we'll have anything along the lines of what was originally feared, like gas rationing that shuts down large swaths of the economy, almost like a COVID 2.0. It depends how cold the winter is, which is another thing I can't predict. But the odds of Europe being okay through this winter are actually pretty good. Could more mass protests erupt? Yes. That's also now less likely given that most governments are stepping up to increase spending in support of consumers and businesses. So to sum it up, I think the situation is currently very bad, and that's widely known. But much less widely reported are a few key reasons for optimism that the worst could be avoided. And if the worst case scenarios are avoided, I think there could be some really interesting opportunities coming out of this crisis, as there usually are. The three I'll discuss here are natural gas producers, industrials, and utilities, all mainly focusing on companies based in Europe. The opportunity for natural gas producers is the most obvious. Pre-war, Russia supplied Europe with almost half of its natural gas imports. I think it's pretty safe to say, regardless of the outcome of the war, Europe's days of relying on Russia for their energy needs are over. So who's gonna step in and fill that void? Well, it's a big opportunity for natural gas producers who can grow production and meet some of Europe's need. And that includes companies in Europe, the US, and the Middle East. But it's also a big opportunity for companies that will build the infrastructure they need to distribute the gas around Europe. That's one of the reasons that losing Russia's oil has as big of an issue as losing Russia's gas. It's a lot easier to get oil from other places. Gas is hard to move around in large parts of Europe don't have the right infrastructure for it. For example, US natural gas imports come in the form of LNG, or liquefied natural gas. Once it arrives, it has to be turned back from liquid form to gas form before it can be used. But most of Europe's regasification plants are in the Western countries like Spain. So not only will they need more gas supply, but they'll also need a lot more gas infrastructure, like regasification plants in other countries and connections to transfer gas between countries. A lot of these opportunities will be capitalized on by industrials companies, which are our second area of opportunity. Not only will some of them be involved in building new gas infrastructure, but as a group, they're also largely very cheap stocks right now since they typically sell off in recessions. And a lot of them have stable businesses with pricing power and the ability to do okay in an inflationary environment. And many of them will play a part in building the infrastructure for the green energy transition. I already did a video on investing in the next industrial revolution, so I'll be sure to put a link up for that at the end of this video. But before I go, I'll leave you with one final opportunity, which is also related to the green energy transition, and that's utilities. Now, not all European utilities are created equally, but within the sector, I think there are a couple of different areas of opportunity. A lot of them could benefit as gas prices come down over the next couple years. A lot of them could benefit if the windfall taxes turn out not to be as bad as what's currently priced in, which is my expectation given the challenges to implementing them that I mentioned earlier, and some of them are also global leaders in producing clean energy. I've seen some articles trying to blame this crisis on Europe's reliance on clean energy, which to be honest, I find absolutely ridiculous. The problem has been their reliance on Russian oil and gas. Sure, the short-term solutions are more fossil fuels like oil and gas from other places and more coal usage, but clean energy is the long-term solution, since no one can turn off the sun or the wind. It's crisis times now, but we've still seen governments around the world pour more money into renewables this year, and I would argue that the urgency of producing more clean energy has gotten even stronger because of this crisis. It used to be because it was clean, but now it's also because it can be disrupted by unstable foreign governments. And let's be honest, importing more from the Middle East isn't a much better solution than getting it from Russia. Have we forgotten about the cause of the last energy crisis in the 1970s? It was Middle Eastern governments cutting off our supply of oil, much like Russia is doing to Europe with the supply of gas right now. These are not recommendations, but as for how to access these opportunities, I'll just leave you with a few options. There's no way to invest just in natural gas producers through an ETF or mutual fund wrapper. You can only gamble on the commodity price itself. The closest thing would probably be to buy something like the iShares MSCI Global Energy Producers ETF, which has the ticker symbol FILL, F-I-L-L. I don't focus on individual companies on this channel, but the top 10 holdings here include many of the potential beneficiaries of the newfound demand for natural gas in Europe. As far as European utilities, there's no ETF or mutual fund available for US-based investors that isolate them, but a decent proxy could be the Global X Renewable Energy Producers ETF, with the ticker symbol RNRG. It doesn't invest in a lot of the most boring conservative utilities, so don't expect a smooth ride, but it does invest almost entirely in utilities, and about 1/3 of its assets are in Europe. As it sounds like from the name, this one focuses on companies that produce renewable energy like wind, solar, and hydro. Industrials are the easy one, and for that you can look to the iShares Global Industrials ETF, ticker EXI, that I highlighted in my video on investing in the new industrial revolution, which you can see here. If you're still with me, I hope you've gotten a lot out of this video. And honestly, there's so much to say, I could have gone on for an hour. So if you have further questions about anything I said or something I didn't mention, please leave a comment below and I'll be happy to expand. And if you want to know the 9 habits you need to be a successful investor, check out the link below in the description. Thank you for watching, and I will see you in the next video.